Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, now here's a little grid, a little comparison chart, because one of the things you have to figure out is you have to figure out what strike prices do you want to use. And really the strike prices you choose is just all about how bullish or how bearish you are. So it's pretty simple. I just put this together because I think it's kind of easy to visualize it. When you trade stocks, there's two sentiments, or there's two opinions that you can have about the underlying. You can either be bullish or bearish. That's it. There aren't any other choices. If you're neutral, you don't trade stocks because you can't make money in a neutral market. But when you trade options, there are four separate possibilities. You can either be bullish, neutral, breakout, or bearish, any of the four. Now today, we're only talking about bullish and bearish, but it's possible to actually do these if you're neutral. So what I like to call that bullish with a neutral bias, or bearish with a neutral bias. And that's how you decide what strike prices to choose. So in the first example, this is the bullish spread. You use a credit put spread. If you're extremely bullish, notice on the left side here, let me see if I can get this pointer to work. How's this? Can you see that? That's good. If you are extremely bullish with a magnitude of extreme, then you want to use ITM options, and that stands for in the money. That means that the put option that you buy and the put option that you sell are both in the money. Now realize that when you do a credit put spread and both options are in the money, the underlying is going to have to rally substantially so that both of them end up out of the money. Because remember, on a credit spread, you always want the options to expire worthless. So if you start out with both legs of your spread in the money, then they have to expire worthless. It's going to require the underlying to rally substantially. Now, if you have not quite such a bullish outlook, then you might want to consider using at-the-money options. If you use at-the-money options, then you can actually have a moderate outlook. If you have a moderate outlook, then you would use at-the-money options. How do I get this thing to go away? Okay. And if you are just neutral or just slightly bullish, then you would want to use options that are out of the money. Because remember, again, if you're trying to get both options to expire out of the money, if you start out where both options are already out of the money, think about it. The underlying doesn't have to move. All it has to do is stay where it's at. So I like to say that a bullish spread, a bullish credit spread using out-of-the-money options, which is slightly bullish, is not really a bullish spread. It's a non-bearish spread. And that's why I mark it on here as bullish and neutral, because it doesn't necessarily have to go up. It just has to not go down. And that's not the same thing. On the other hand, if you look on the bear spread side, it's the same sort of thing. You're going to have, you have the ability to have an extremely bearish sentiment. You want to use in-the-money options. You're going to have a substantial downside move on the underlying, because if both options start out in the money, you want them to get out of the money so they expire worthless. It's going to have to move lower sharply so that it moves past both strike prices. So only do that when you're really sure that you're very, very, very bearish. And you might say, well, why would I do that when I could do okay and actually make a profit without the money? Well, the truth is, if you're extremely bearish and you use in-the-money options and you're fortunate enough to have it move down sharply, you'll make a much larger profit than if you use out-of-the-money options. So that's why you have to sort of adjust it. If you've got an extremely bearish outlook, you might as well go ahead and use the in-the-money options to try to maximize your profit as much as possible. Whereas if you have a moderately bearish outlook, you might want to use options that are roughly at the money. And typically on a spread, when I say at the money, what I'm generally talking about is one strike will be above the underlying and one strike will be below the underlying. In other words, one's in the money and one's not. In this case, the underlying only has to move far enough to get one of the options to be out of the money because the other one was already out of the money. And if you think about that, you'll realize it doesn't need to move quite as far. Now, if you're bearish or neutral, which I would call a non-bullish position, then you can use out of the money options. If they start out of the money already, they're not going to bring in a huge credit, but the underlying doesn't have to move hardly at all, or in fact doesn't have to move at all, and they'll both expire worthless. So adjust your strike prices based on your degree of bearishness, or how confident are you in which way you think that currency is going to move. Or maybe you do your trades based on looking at the chart and do some sort of technical study. How confident are you in your technical studies, your skills in reading technical analysis, or based on what that chart pattern looks like? How much confidence does it give you? That's how you decide what strike prices you use. You don't want to use an in-the-money spread if you're just slightly bearish, because you know what's going to happen? You're going to lose money. It's not going to happen. And you don't want to use an out-of-the-money spread if you're extremely bearish, because you know what might happen? You'll make a very small profit, and you might have had a great big profit. So you want to always maximize that the best you can. All right, let's take a look at actual charts. Now, what I tried to do when I put this deck together, which was a couple of months ago, I had to run it through compliance and all that, so that's why it's not current. It was in very early May, as you can see by looking at my chart. What I tried to do was pick 4 of these 6 currency pairs that the ISE offers, and I tried to put together 2 that I thought maybe had the potential to have a bullish move, and 2 that I thought maybe had the potential to have a bearish move. Now, what's interesting is the dollar lost ground against all the major currencies during this period of time, or between April and the May expiration. So I've got 2 examples that are bullish and 2 that are bearish. The 2 bullish trades lost money. The 2 bearish trades made a nice profit. So it just turned out that way. So here's an example of the bullish trade. So I looked at the dollar versus the Canadian, and I just, looking at the chart, this is what the dollar versus the Canadian chart looked like, which is the CDD. That's the symbol for the ISE pair of the dollar versus the Canadian. And what you can see is that from early March all the way down to early May, the dollar had been losing ground versus the Canadian dollar. But I went into this chart and I drew this red line, which is where I believe there's some support. And the reason I drew this support here is because if you go back to January, you can see that at the beginning of January, the dollar came down to that line a couple of times, maybe 3, depending upon your outlook, and then sharply rallied off of that level. If you go further back, and I don't really show it on this chart, but you might even see that back here in mid-December, there was also a day where it came down and touched that exact level. And you might even find, if you went further back, that there were a couple of other times where it came down and touched that level and then moved higher. So if you are a technical person, you might go in and draw that red line and say, hey, there's some support here. Well, and in fact, when I was putting this example together, you can see that we had 2 days where the dollar came down right to that level. Yes, the day before I put this together, you can see that it closed on that level. And then the day that I was putting it together, it had gone down to that level and it turned around and is now starting to move higher. So based on that move, I'm thinking, hey, you know what? There looks like there might be some support here. So maybe the dollar is going to move up again the same way it did in early January based on this level. It looks kind of similar. So I decided to go out there and put on a credit put spread, which is a bullish trade, on the dollar versus the Canadian dollar. And I did that based on the fact that I believe we're looking at an upturn. And I say that because we're bouncing from the downside support level, which is where I've drawn this red line in. Now, here's the trade that I chose to do. I looked at the prices, and I saw that I could buy 10 of the May 116 puts at a price of about 48 cents. And at the same time, I could sell 10 of the May 121 puts at a price of 318. Now, if you go down and look at the price of this index, it's at 117.69. So based on these 2 strikes, would this be considered at the money, in the money, or out of the money? I know you can't answer, so I'll answer for you. This would be considered at the money, because remember what I said, at the money is typically where one strike price is in and 1 strike price is out.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.